because once they print the dollar for the last time, silver is going to go through the roof. And I don't even know where the roof is. Well, hello there, my friends. Rafi here from the End Game Investor with this week's Silver Report for Arcadia Economics. And if I seem a little uppity, it's because a woman that I sue. It's because I am. And maybe you'll find out in a week or two why. Maybe you won't. Depends what happens in court. Anyway, today we're going to discuss silver backwardation entering week 3. The explosion of reverse repos breaking through the $2 trillion mark, and what happens when the bonds on the balance sheet of the Fed drop in value to the point where they can't collateralize the reverse repos. And if you don't understand that, that makes sense that you don't understand it because it's very esoteric. And even I don't understand it, but I'll try to explain it even though I don't really get it. Gold deliveries begin today. And if you're watching this on Friday, then they already began. Open interest and price is still diverging in the gold market. And the last time this happened was leading up to the February double top spike to 2080. And we're going to go over something that I guarantee you've never seen before. There is always a drop in the money supply of between 1 and 1.5% on the week following tax day, and a whole bunch of money is vacuumed into the Treasury's bank account and out of the banking system. And something happened after this tax day this year that has never happened before. This is a handy, trusty, dandy, color-coded silver backwardation table that I compiled from the CME website for all of the trading days of May. This column here is spot silver, silver for immediate delivery. This column here is June silver. When spot silver is above the price of June silver, that is backwardation, which means people are willing to pay a premium for silver delivered now rather than June silver. And one thing you have to understand about spot silver is that this contract is not a futures contract. Once you buy it, you are risking taking delivery. So anyone who buys a spot contract in the delivery month is expressing his intent for physical silver. He might sell out of it before it gets delivered. It gets delivered by lottery. But still, when you buy this contract, instead of a futures contract, you are indicating your desire for physical metal and willingness to pay a premium for it if the price is above the June futures. So here, spot silver, here, this column over here, this here, hey, column, the southern equivalent of that. So June silver in this column, and here's the difference. So May 2nd, we had a difference of -1, means there was a premium for futures. This is not backwardation. From May 3rd to May 10th, the difference between the spot silver price, May silver for immediate delivery, and June silver futures was 0. Not quite backwardation, but people were not willing to pay a premium to wait for time. Starting on May 11th, we started to see backwardation in the silver market. That was when there was a big sell-off, and you started to see a premium develop for spot silver, physical metal, over June delivery. And that premium started getting bigger, first by 0.5 cent, and then on by May 18th, 2 cents, and then May 22.5 cents, and then finally May 23rd and 24th, 3 cents. It went down 2 cents, but it is still backwardated. This is the 3rd week of silver backwardation. It means very high tightness in the physical silver markets, and that is also reflected in the premium, which I believe right now is about 22-23%. Now here is what I mentioned at the end of my introduction. This is going to take a minute to explain. You see, the only thing that really matters in booms and bust cycles is the amount of money in the system. Interest rates are a tool to manage the money supply. Everything is a tool to manage the money supply. Bank lending on fractional reserve is a tool to manage the money supply. As long as the money supply keeps going up and up and up and up at a constant or accelerating rate, you have a boom. Once it stops going up, after a boom, you have a bust. Because for the same reason that a heroin addict needs higher and higher doses of drugs, the economy needs higher and higher doses of monetary drugs to sustain a boom, because the bigger it gets, the more money that is needed to keep it expanding. And once it stops expanding, it collapses. That's the nature of the beast. And so here, these are the largest week-to-week drops, meaning the money supply a week before to the money supply on these dates. These are the biggest drops ever from 1982 by the money supply statistics from the Federal Reserve. You will notice one very obvious thing, that almost all of these huge drops, these are the 27 biggest ones, and almost all of them happen in the last week of April. You will see the 3 biggest ones. And this one from September 24, 2001, we can scratch it off because it was in the immediate aftermath of the September 11th attacks. and that was a rush to cash after a big explosion in money printing that happened the week after September 11th. That was a special case. Forget it. Now, the top two were April 28th, 2008, and April 25th, 2022. It's just passed. We just got the stats out for this on Tuesday. The crash in money supply of 1.7% in April 2008 eventually led to the September crash of the market in 2008. We all know what happened then. This crash in money supply of 2% from the second week of April to the third week of April, or was it to the third to the fourth, whatever it is, from April 18th to April 25th, of over 2% is the first time that has ever happened, excluding September 11th. We are headed for a huge money supply collapse and a possible collapse of the entire system by August, September, which is the timing of when it happened in 2008. But this time they can't inflate their way out of it. They can, but they will kill the dollar. So we're getting very close here to something big, is the point. What is going to happen to silver until that big crash? If it happens and the Fed doesn't turn around, the Fed could always turn around and reverse this whenever it feels like it. But if they are on the path to trying to deflate inflation, then they will continue until there is a crash. What happens to silver in the meantime? It could get rough, and you've got to understand that. You've got to internalize it, and you've got to be tough. Because once they print the dollar for the last time, silver is going to go through the roof. And I don't even know where the roof is. And now let's go through something a little bit weird. For the first time ever, because we live in a base 10 system, because we have 10 fingers, 10 toes, so we think that numbers that end in zeros or round numbers that are multiples of 10 have significance for some reason. Be that as it may, reverse repos top $2 trillion for the first time ever. A reverse repo is when a bank has too much cash, so it gives the cash to the Fed in return for treasuries so that it doesn't pay fines and the extra cash it doesn't know where to put it. Now, there's a problem here that I haven't heard anyone talk about, not even Zoltan Pozsar, that Hungarian, I think, guy who talks about money plumbing all the time. So let's go into this problem. $2 trillion of reverse repos. So they give this money to the Fed, and the Fed is supposed to give them $2 trillion, a little bit less worth of treasuries, and the banks earn that money. There's a problem here. What is that problem? The problem is this. Here is the problem. It's on the balance sheet of the Fed. So I've blown this up a little bit so you can see it. Here you have factors affecting reserve balances. This is basically the balance sheet. So what do you have here? The reverse repos that are on the Fed balance sheet, they're on the Fed's balance sheet because the Fed is what is taking in this cash in return for the treasuries that they're giving to the banks who have too much cash. $2.16 trillion in reverse repos. This is all on the Fed's balance sheet. Now, they have to give equivalent in treasuries for that cash. How much treasuries do they actually have? U.S. Treasuries securities, notes and bonds nominal, $4.975 trillion, about $5 trillion in bonds. Notes and bonds, that's from 2-year maturities to 30-year maturities. What happens when the value of these bonds fall because interest rates are rising because the Fed is trying to fight inflation? What happens if they don't have enough bonds to collateralize reverse repos, which are going up and up and up because the banks keep getting more and more and more money? What if there, in short, is not enough cash to collateralize trillions of dollars in reverse repos in treasuries because they keep hammering the price of treasuries? We're talking about a monetary singularity here that is basically unfathomable. And it's hard to say what would even happen. Other than we know what's going to happen, it's going to be the destruction of the monetary system. But theoretically, let's say that the Fed cannot collateralize reverse repos with treasuries because it doesn't have enough nominally to do it, and there's too much money. So then what happens? All that money has to go somewhere, so it floods into the economy, into the marketplace all at the same time, and you have the end of hyperinflation, which is where we're headed anyway. Exactly the mechanisms how we get there, nobody knows for sure because this is all so screwed up. But whatever happens, it's going to be talked about in the history books for as long as the human race exists. And we are alive to see it. We've got front row tickets to the end of the world, baby. Let's go to gold for a second. Gold deliveries start tomorrow. We have here June gold at close open interest. This number right here that I'm highlighting, 69,940 contracts. This contract becomes spot tonight. So the closing open interest is going to be the number of gold deliveries that happen for June, and the record all time, I think, is May 2020 of 55,102. So we could have possibly a gold warrant delivery record. There's not going to be a gold default because according to the vault statistics, there is enough gold to deliver against all these contracts. And usually short interest and price pressures abate after delivery day. So we could see a big rally in metals coming in the next few days. But let's continue. Here I want to share a news development here. Russia to service debt in rubles after U.S. closes loophole. Okay, so think about this. The U.S. wants to hurt Russia, so it cuts off its access to dollars so it can't serve its dollar-denominated debt. So instead, Russia pays its dollar-denominated debt in rubles, which technically breaks the contract. But as long as the creditors don't mind, because why wouldn't they rather have rubles than dollars? The ruble has been going up like crazy since February 24th. And really, this is a test of the concept of a gold standard, because whether officially or not, Russia pretty much is on a gold standard because it's been expanding its money supply at the same rate that it's expanding its gold reserves. So that is a gold standard. Now, if its creditors accept rubles, which are de facto backed by gold, and don't care about the default in dollar-denominated terms, then this is another nail in the coffin of the dollar as the reserve currency. I don't know how many nails are supposed to be in that coffin, but they keep nailing them in there. And if I were a creditor of Russia, I just take the rubles. Who wouldn't? Anyway, let's go to this final chart here. And that are these trapezoids that I've drawn in the gold price versus the open interest. The top is the gold price. The bottom is the open interest in gold. And we've seen in February what happens when price rises, but open interest falls. If price rises and open interest falls, that means the longs are not opening new contracts and the shorts are covering, which means the shorts are expecting higher prices and the longs are too scared to chase because they're too bearish, which is what was happening here. And here we saw this massive run to 2080 or 2090 or whatever it is to the all-time highs. And here we're seeing this pattern again. And when you have these trapezoids, typically you have a run. How long it will last, I don't know. But one of these days, Alice, one of these days.
One of these days, Alice. Bang, zoom, straight to the moon.
This is Rafi, the Endgame Investor, coming at you with this week's Silver Report for Arcadia Economics, and I'll see you next week.
Wow, I never realized the first astronauts were so fat.
That's not an astronaut, it's a TV comedian. And he was just using space travel as a metaphor for beating his wife.